Hi, this is Lara at Elliott Wave Gold with your daily analysis. For Friday, the 5th of June, I'm recording today's video just after markets closed, 4:35 p.m. I was expecting downward movement. We had two targets. The first target was met and exceeded by 2.2, and now I have two wave counts. The first, more likely, expects this downward movement is not over, and we'll have another red candlestick probably for Monday. The target is 1157. Or it is possible this downward movement could be over, but I think that's less likely. That would be confirmed, though, if we get a new high above 1179.60. At that stage, both bull and bear wave counts would be expecting upward movement. The bull for a third wave and the bear for a second wave correction. Let's have a look at the charts. And I'm not going to pick a winner. I'm not going to prefer either bull or bear wave counts. Both have many points in favour and against. Volume does continue to favour the bear wave count though. So maybe that's slightly more likely, but I think we really do need to let price tell us which one is correct. The bull wave count sees a trend change off to the left of the chart at that low 1131 at cycle degree. There, cycle wave A may have ended and cycle wave B may have begun. Cycle B should move price higher and or sideways for 1 to several years. Its A wave is incomplete and subdividing either as a zigzag or an impulse. A waves can be 3s or 5s, so there are multiple structural possibilities. The only structure an A wave can't take on its own is a triangle, but we can narrow it down to just two structures in this case because the first wave up here is so clearly a 5-wave structure. The only potential solution I can see where this upward wave ending here is a 3 is a very rare triple zigzag and it has all the wrong looks, so I'm 99.9% confident that this wave here is a 5, which means if intermediate B or 2 were to drift sideways as some kind of combination, it can't move beyond the start of A or 1 at 1131.09, and that's why that's the final price confirmation required for the bear wave count. If primary A is a zigzag, it will subdivide 5, 3, 5, and intermediate C is likely to be an impulse, not a diagonal, because it's very unusual for both A and C waves to be diagonals. This A wave was a leading expanding diagonal. If primary A is an impulse, it would be labelled 1, 2, 3, and the third wave must be an impulse, so I'm expecting an impulse up at intermediate degree. So far we have 1, and the second wave correction is a very common expanded flat, subdividing 3, 3, 5. If the C wave is over here, it is very close to 1.618, the length of the A wave, and within it the fifth wave is close to equality in length with this first wave, so that would be quite satisfying with those Fibonacci ratios. It is entirely possible though, and I think it's actually more likely, that Monday's going to see a bit more downward movement. Minor 2 may not move beyond the start of 1 below 1142.82. When minor 2 is done, we will expect a third wave up. If minor 2 is over here, the third wave will reach 1.618, the length of the first wave, at 1288. Along the way up, a new high above 1232.49 would invalidate the bear wave count and confirm this bull wave count at the daily chart level. The first target is for primary A to be a zigzag at 1320, where C will reach equality in length with A, or the second target, 1429, is if primary A is more likely an impulse, where 3 would reach 1.618, the length of 1. Let's have a look at how this final fifth wave may have unfolded at the hourly chart level, where the fourth wave ends here. It was a barrier triangle, and the fifth wave could possibly be over. I've checked the subdivisions, particularly within the middle of the third wave here, so carefully on a 1-minute chart. It must subdivide as an impulse. It'll only do that if we look at it on the 1-minute chart. There are some really quick fourth waves in here because the fifth wave within the middle of the third wave is a strong, swift, extended fifth wave. And that's pretty common for gold. When it has those swift fifth waves, typical of commodities, they turn up within a third wave. And so those quick fourth waves in here give this movement a 3-wave look. at the hourly chart level, but it does subdivide as an impulse at the 1 minute chart level, a lower time frame. The problem here, if minor 2 is over, is then within minuet wave 5 there are no adequate Fibonacci ratios between 1 and 3 and 5, and that's actually somewhat unusual for gold. That's pretty much the only reason that reduces the probability of this idea. And please note also, both these hourly wave counts, this one which sees the downward wave over, and the next one I'll go to which sees it continuing, work exactly the same way for both bull and bear wave counts. If it's over here, then within minor wave 3, which may only subdivide as an impulse for the bull count, no second wave correction may move beyond its start below 1162.80. At any stage, a new low below this price point, even by the tiniest amount, would invalidate the idea that this fifth wave is over, and then for both bull and bear would be using the other hourly chart and its target. To the upside, at any stage, a new high above 1179.60 would confirm the idea that this fifth wave is over and we're in the next wave up, and I would want to wait for full and final confidence with a clear breach of this best fit channel copied over from the daily chart. When we have at least one full hourly candlestick above this trend line and not touching it, we'd have full and final trend channel confirmation that this whole wave down is over, and then the next wave up would be underway. At the daily chart level, this is the bear wave count. It looks at the possibility that cycle A and primary 5 are not over, that primary 5 is still continuing to reach equality in length with 1 at 957. Within primary 5, the third wave begins here with a very long extended first wave impulse, a second wave zigzag, which is just a little over twice the normal duration of a minor degree correction within gold's intermediate degree impulses normally are, so that's a little problem with this wave count. But again, volume clearly supports this wave count. On balance, volume has breached a trend line at the weekly chart level. The weekly chart has stronger volume for down weeks within this sideways movement, and the daily chart also has strongest volume for down days within this sideways movement, but we do not have a bearish breakout confirmed yet, so both bull and bear wave counts are viable. When minute wave 1 is over, then the bear count will be expecting a second wave correction, which may not move beyond the start of the first wave above 1232.49, and that's why this invalidation point differentiates the bull and bear wave counts to the upside. To the downside, a new low below 1142.82 at any stage would provide quite a lot of confidence in the bear count, but it would still require full and final confirmation below 1131.09 before all bullish variations would be eliminated. At that stage, I'd have a lot of confidence in this very low target. Let's look at the idea that the fifth wave is not over, where the fourth wave barrier triangle ends here. This idea, again, it works in exactly the same way for both bull and bear wave counts. If this downward wave is not over, then we have 1, 2, 3 ended here with a swift, strong fifth wave within it. That's really typical. And 4 may be unfolding sideways. There's no Fibonacci ratio here between the third and first wave, so the fifth wave would be very likely to exhibit a ratio to either 1 or 3, and the most likely ratio would be equality in length with 1, which was 12.11 in length, and that would take price, depending on where the fourth wave ended. If it ends a little bit below this point, it would take price nicely down to the target. At 1157, minuet wave 5 would be a very long extended wave. It would reach equality in length with minuet wave 3. This is a fifth wave following a barrier triangle fourth wave correction. Fifth waves following barrier triangles are usually one of two things. They're usually either very quick and brief, or they're very long extensions. This one has now lasted 3 candlesticks, so I think it's much more likely, actually, it's going to be quite a long extension. So I think it's more likely that we're going to see some sideways movement for several hours for a fourth wave, and then a final fifth wave down on Monday and or Tuesday possibly. The fourth wave should show alternation with the second wave. This was a quick zigzag, so I'd look for the fourth wave to be a more time-consuming flat combination or triangle. It's quite likely to end within the price territory of the fourth wave of one lesser degree, and this is microwave 4's price territory here. Within it, if it's an expanded flat or running triangle, it may even have a B wave, which makes a new price extreme beyond the start of the A wave. So at any stage, a new low below 1162.80 would confirm the idea that this downward wave is not over. It could, though, just still be part of the fourth wave. If the downward movement that does that is a really obvious three-wave structure, it's probably still the fourth wave unfolding. This fourth wave may not move into first wave price territory above 1179.60. That's why this invalidation point very clearly and easily will differentiate these two ideas for us. And again, they work exactly the same way for both bull and bear wave counts. From a regular technical analysis perspective, we have a full daily candlestick below and just touching this lower horizontal trend line. These trend lines started here and here delineate resistance and support, and I've got a point, I think it's a 0.3% range for the upper and the lower, sitting on this low here, and for the upper sitting on this high here. We've got an overshoot here. That's happened on the opposite side. We had a full green candlestick above the upper edge. That was not an indication of a bullish breakout. And to the downside, this is not an indication of a bearish breakout either. We need to have this trend line breached by a close of 3% or more of market value. That's actually at 1143.60, I think that is. Quite a long way away, in order to use it in the manner intended, and that, only that, would indicate a bearish breakout. ADX remains below 15 and it's still flat. There is still no clear trend indicated, so still a range-bound trading system should be employed as opposed to a trend following system. The range-bound system I'm illustrating here uses stochastics to indicate overbought and oversold, and the trend lines to indicate resistance and support, with stochastics still nicely oversold and now priced below the lower trend line. An upward swing should be imminent using this approach. There's a wee drop in volume for Friday's session, a slight cause for concern for this downward wave and maybe an indicator it's coming to an end, although the market can fall of its own weight. We have a very long lower wick on this candlestick. That's a little bit of a bullish indicator. So this regular technical analysis approach expects an imminent end to this downward swing and the beginning of the next swing up. Trading a range-bound market, as gold has been since this date here back on the 27th of March, is highly risky. It's best left to experienced experts only, and if you're going to trade this kind of market, good money management techniques and a close management of risk is exceptionally important. There is a higher risk of loss in this kind of market, as illustrated so nicely by these overshoots and these breaches of these horizontal trend lines. It's really difficult to pick when a swing ends and the next one is about to begin. That's all for me today with your gold analysis, and I hope that all our members are looking forward to a fabulous weekend.